Welcome back to Financial Fortitude, where we help high earners and families make intelligent financial decisions so they can live well today and retire on purpose tomorrow. I'm Michael Acosta.
And I'm Brady Hemmerly. Today we're breaking down what the One Big Beautiful Bill Act changed in the federal student loan world, and more importantly, what you need to do before the key deadlines hit.
This is especially critical for three groups we work with every day. First, public service loan forgiveness physicians and hospital employed professionals. Second, high-income borrowers pursuing 20 to 25-year time-based forgiveness. And third, parents holding large sums of Parent Plus loans that they took out on behalf of their children.
Because after July 1st of this year, 2026, the environment looks materially different.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Michael, I'm pretty excited to talk through this because I know it's one of the areas that you really have a strong expertise and understanding of and makes a huge impact, especially for any high-earning professional kind of stepping into the world or maybe already been in the world of earning and saving for the future, but also working towards how to actually eliminate their student loans. So a lot of changes, a lot of cool stuff to talk about.
Definitely a lot of changes with the passing of the One Big Beautiful Bill last summer. And it didn't go into effect immediately, and so it's going to be going into effect slowly over time. But the initial launch date was some of it taking place at the beginning of this year, 2026, and then additional changes occurring in July of 2026, and then most of it being implemented by July of 2028. So there's still a little bit of a runway for certain groups, depending on what their strategy looks like and how they're addressing their loans. And so the ultimate goal today is just to provide some high-level insights into what is changing and maybe things that you should be considering if you're in one of these three primary groups that we're going to be discussing.
So as we kind of jump into this, we're going to bounce between a couple of different thought processes here, but the first sort of major change is in the realm of Parent Plus loans. I think there's some adjustments where doors are closing. So can you talk a little bit more about what date's impactful there and then who's actually going to be affected? And then I'm sure I'll have plenty of questions as to what strategies to think through.
Yeah, Parent Plus loans are a unique loan set in itself. It's usually a parent who's taking out a loan in their name on behalf of a dependent child that is actually the full-time student attending university or school. These loans traditionally have not been favorable when it comes to paying back just because the Parent Plus loan itself doesn't offer many repayment options outside of a standard repayment and I believe a graduated repayment structure. So again, these payments are usually less attractive, not eligible for forgiveness. Now, what used to be this quote unquote loophole that we would help clients take advantage of with Parent Plus loans is what's known as a double consolidation. I'm not going to go into the details of how it works, except that through the double consolidation loophole, borrowers, these parents, were able to transition into an income-driven repayment plan, which we talked about in the past and how advantageous that is, but then also making the loans eligible for both public service loan forgiveness if the parents were still working in the public service sector, not the child who actually went to the school, but the ones who own and hold the loans, or time-based forgiveness, which is making an income-driven repayment for 20 or 25 years. Now, what's going to happen because of the passing of the One Big Beautiful Bill and a provision in there is that new Parent Plus loans are going to lose access to income-driven repayments altogether, right? So what does that mean? Well, if I am a parent with federal student loans and I do not have access to income-driven repayments, well, now I am no longer eligible for time-based forgiveness or public service loan forgiveness. Now, there might be critics out there that say, oh, well, you can still be eligible for public service loan forgiveness with a standard 10-year repayment. Yes, that is true. However, if you're paying your loans off in 10 years, you'd likely have nothing left over to be forgiven after your 120th qualifying payment for public service loan forgiveness. So again, the new Parent Plus loans that are going to be issued this year are not going to be eligible for income-driven repayments. Now, double consolidations are still relevant through July 1st, 2026. After July 1st, 2026, they will no longer be eligible to basically execute that. And your real only option that you have is going to be just the standard repayment. Now, you might be able to get an extended standard repayment where they push it out 15, 20, 25 years, but it's not going to be nearly as attractive or advantageous as, say, double consolidating and getting into an income-driven repayment plan.
So, Michael, talk to me more regarding both the new Parent Plus loan provisions and this closing of the double consolidation loophole. In more simple terms, who is affected? Like, who needs to sit there and say, this could be me?
Yeah, so the people who are going to be affected most by this are going to be juniors and high schoolers, I would say, this year, or any student who is starting their higher education at the end of this year, so fall of 2026, right? So think about graduating seniors in high school, going off to college as a freshman. Their parents, right? So what's going to happen is that these families are going to have to start to think about new strategies to how to fund college. It used to be that you would try to fill up the loans that the student could take out in their name first. If you're a high income earning family, the student likely isn't going to be eligible for much financial aid. So that's going to put more pressure on the parents. Now, if the parents haven't saved diligently in 529s, UTMA accounts, really just savings in general, and have no other means for covering the cost of the tuition for their children, then they would take out Parent Plus loans. So if the idea is that we want to try to steer clear of Parent Plus loans, well, that's going to mean that, one, we're going to have to be more proactive with saving, which if we haven't done it up to this point, I'm not really sure how you would pull those strings without sitting down with a financial advisor and allowing them to get creative for you. But it could push you into the realm of taking out a personal loan or private loan as opposed to going through the federal loan channel.
Got it. So what I'm hearing is what was a much more flexible set of options for parents who have either undersaved for potential education costs or just perhaps were strategically using loans regarding education costs. Their world just looks much less flexible, and it could put a negative drag against the entire rest of their financial plan. Right? If I have to take out a personal loan or if I have to take out a private loan, those things don't get forgiven. There's not as much flexibility in repayment schedules. There's just less options for me, basically.
Correct. And there also are borrowing caps that have been adjusted for Parent Plus loans. So that's something that's noteworthy as well for anyone who's going to go down that path. But if we look at a quick case study, and again, we're not going to go deep into the weeds with this, but let's just take parents age 52 and 49 with $180,000 in Parent Plus loans, combined income of $220,000 as a household, hoping for forgiveness as a strategy. Well, if the Parent Plus loans already exist, meaning that they were dispersed prior to 2026 or prior to July 1st, 2026, then there is still somewhat of wiggle room for these individuals to evaluate a double consolidation strategy to get into an income-driven repayment plan. Now, if the child, as we noted just a little while ago, is starting school in 2026 or beyond, this is where they should really reevaluate their funding mix, right, as far as how they're going to cover the cost of tuition for their children. Again, trying to max out what the student themselves can get in their name as an undergraduate from the federal government versus, putting as much of it as possible into Parent Plus loans versus taking out private loans or even leveraging a home equity line of credit or other forms of debt that can be utilized in a optimal or efficient manner. Again, this is where I think it's very prudent to speak with a financial advisor to help break down what your balance sheet looks like and uncover any sort of unnoticed opportunities at hand to cover the cost of the higher education.
So for parents who have students starting education after July 1st of 2026, their main real look at this stage is effectively what is my future funding mix going to look like, because Parent Plus loans may or may not be advantageous to me anymore.
Correct.
For clients who already have loans that exist before July 1st of 2026, you talk very briefly about this double consolidation loophole. Explain what that is, why someone would do it, and then who it may apply to before we actually reach that door being closed on that date.
Yeah, so I would say it applies to any parent today that has Parent Plus loans and is looking for a better repayment strategy, right? So taking that couple that we talked about, 52 and 49 with $180,000 in federal loans, $220,000 in gross household income, if they conduct a double consolidation loophole, let's just say that they have 6 Parent Plus loans in their name, in the husband's name. What we would ultimately do is we would take 2 sets of 3 loans, and we would consolidate them into their own consolidated loans. So you would go from 6 individual Parent Plus loans into 2 separate direct consolidated loans. From that point moving forward, you then do another consolidation. This is where the double consolidation gets its name. And you would consolidate those two direct consolidated loans into a single direct consolidated loan. When that's finalized, now historically, the borrower is eligible for all of the current available income-driven repayment plans. This then makes them eligible for public service loan forgiveness or time-based forgiveness. So again, if I'm 52 with the loans in my name for my child, and I work for the city, or I work for the police department, or I work in a public hospital system, and I'm planning on working another 15 years or 10 years, well, I could potentially seek public service loan forgiveness as a viable option and receive tax-free forgiveness on my loans, right, as the parent. Or if it's time-based forgiveness, I could pay these into early retirement, and after 20 years or 25 years worth of payments, have whatever balance is remaining forgiven. But if I can't do the double consolidation, well, then now my only real option is to just pay them back, refinance the private loans to hopefully get a lower interest rate and ultimately pay them back. Or the morbid part is if they remain federal and I die, the loans are discharged.
So what I'm hearing here is for individuals with Parent Plus loans, your strategy window is closing quickly.
Correct.
And that strategy window, what does it actually affect? It affects what your cash flow and savings effort may look like pre-retirement. It affects what your debt load may look like as you approach retirement. And it affects, I would say, the overall efficiency of leveraging public student loans from a forgiveness standpoint in kind of rounding out a better developed education plan for those parents who aren't just going to pay cash essentially for their students' education.
Correct.
So, Michael, with all of that in mind, then, if I am a parent who's soon to send my child off to higher education, and I'm really starting to question where the funding's going to come from, or perhaps I'm a parent who's got some Parent Plus loans and sees that this door is closing, who do I reach out to, or how do I begin to execute from a strategy perspective before time runs out?
Yeah, I think the first step would be to reach out to a trusted and vetted financial advisor just to review what you have going on financially. And if you're planning for college, then you want to at least partner with a financial advisor representative that has experience in college planning, right? And this is pre going off to college and paying for the cost of the actual education. If you already have the loans, you will want to more than likely work with a certified student loan professional, CSLP. You can go to the website and search for them. I myself am a certified student loan professional and have experience on both the college planning side of things as well as the repayment strategies. So if you're someone who falls into this camp and you're looking for someone to interview or at least kick the tires on, feel free to reach out to our team here at Genesis Wealth Planning. We'd be able to at least confirm or deny if we can help you out.
Okay, so we've talked a lot about parents who are considering sending their children off to college. Let's talk more about individual borrowers, now the children, essentially. What does their world now look like, or what's being changed? If, hey, my parent hasn't taken out the loan, I've taken out the loan. What's changing in the world here?
Yeah, so what's changing here, I would say, is pretty significant for federal borrowers. And again, this is from a repayment perspective, so this will impact all federal borrowers, whether you're the parent or the individual. But if we get hyper-focused on just the individual themselves, the income-driven repayment realm is going to go from being about 5 to 6 income-driven repayment options down to practically 2 over the course of the next 2 years. So what really jump-started all this was back in 2024 when the Saving on a Valuable Education plan, SAVE for short was the acronym, actually fell into a lawsuit with the former administration. And then when the new administration came in, that lawsuit basically got overruled, in my mind, may not be the exact terminology, with the passing of the One Big Beautiful Bill. And so what this new bill did when it was passed last year in 2025 is it said, okay, starting in 2026, we're going to go from having 5 different income-driven repayment plans, 5 to 6, which some of them were incorporated or established by Congress. Others were established through executive order by whichever president was in office during that period of time. And we're going to have 2 income-driven repayment plans. An existing one known as income-based repayment. And now income-based repayment is calculated in 2 different fashions. For older borrowers, it's using 15% of the household discretionary income to calculate your annual and monthly payment. For newer borrowers, it's using 10% of the household discretionary income to calculate your annual and monthly payments. So for older borrowers, it's not great. For newer borrowers, it's not as problematic, okay? Now, the other repayment plan that's going to be available later on this year, I believe it's supposed to be July 2026 when it kicks out. We'll see if they get everything set up on time with the education department, is the repayment assistance plan. It's RAP for short. So the way that this plan is supposed to work is that they're going to use on a scale of 1 to 10% of the borrower's household discretionary income to calculate the annual and monthly payment. Now, it's progressive, somewhat like our marginal tax rates, in that if you earn less than $10,000, they're using 1% of your discretionary income. If you earn less than $20,000, they're using 2%. If you earn less than $30,000, they're using 3%, right? So on and so forth. So your break points are every $10,000. When you earn over $100,000, it's just 10% of the household discretionary income, right? So example, if I am a resident in training and I'm earning $55,000 with the RAP plan, they're going to use 5% of my household discretionary income, okay? Now, from there, they're going to deduct the calculated payment by $50 per dependent. With the income-based repayment plan, it was a little bit different. They would deduct against your adjusted gross income an inflated U.S. poverty line amount based off the size of your family. So whether or not it's a bigger discount on one end or the other, we would have to run the numbers to be able to confirm. But for lower income earners, the RAP plan could be a viable option. And again, both of these are going to be eligible for both time-based forgiveness and public service loan forgiveness.
Okay, so what I'm hearing is the menu is getting smaller from an option standpoint.
Correct, yep.
I'm coming out of education at this point, whether I'm now a resident or perhaps just stepping right into my first career. What was 5 or 6 different menu options and more strategy is now being reduced to 2. And those 2 different options look slightly different just depending on where my income falls and a lot of what goes behind the scenes in the calculations.
Correct. And so as far as key dates, so the RAP plan is supposed to become eligible by July 1st, 2026. Income contingent repayment, pay as you earn, and saving on a valuable education, which saving on a valuable education was practically already phased out for the most part. Federal borrowers were notified that they should be opting into a new income-driven repayment plan by January 1st, 2026. There may be some leniency there, but pay as you earn, income contingent repayment, they're going to be phased out by July 1st, 2028. So if you're in pay as you earn now, you can technically stay in that until July 1st, 2028, and then you're going to be required to move to either income-based repayment or the RAP plan. Now, one of the things that we have to be mindful of is that student loan strategies and legislation shift like a pendulum depending on which political party is in power at the various levels of government. Because new laws can be passed, legislation can be changed, executive orders can be signed. So it's not going to be a set it and forget it, but we have to plan according to the rules of engagement. We have to make the best of the current situation. And so if you're being significantly impacted by these changes, yes, it's frustrating. It might create anxiety or stress, but sit down, review your options, and let's make the best choice moving forward based off what we know today would be my advice there.
So kind of a sidebar question here. Let's say I jump out of medical school, I'm now a resident, and I decide from a planning perspective to use RAP at first. Can I switch into IBR later if it makes more sense for me, or am I then basically committed to RAP for the course of my payment schedule?
So that is a unclear area at this point. The way that I interpret it is that once you go into RAP, you're pretty much stuck into it. But the underlying writing to that is I know for certain if you are a new borrower in 2026, you may only be limited to the RAP plan as a federal borrower in 2026.
So similar to your past comment, it really depends on what not only the political environment looks like, but the rules of engagement look like and what your options could be. So something that now requires more monitoring, less set it and forget it.
Correct. And if we look at a quick case study, again, at a high level, let's take a hospital employed physician, right? $340,000 in federal student loan debt between medical school and undergraduate. They were currently in the saving on a valuable education plan, the SAVE plan, heading into the new year. And there were 4 years of potential PSLF credits? Well, the first thing we need to do is we need to take an audit of how many of those 48 months are qualifying, right? Because for most of the last 5 years, going back to March of 2020, federal borrowers have been in and out of administrative forbearances that were forced, some with the SAVE lawsuit and some without it. We at least know that from March 2020 through relatively through the end of 2023, for the most part, that those non-payments during the administrative forbearance do qualify towards public service loan forgiveness. They're supposed to. Now, from the SAVE plan, when the lawsuit took place in the summer of 2024 through the end of 2025, more or less, that's a period of time where all of those months may or may not qualify for PSLF as non-payments. So we would need to take an audit, and then we would need to be able to confirm which income-driven repayment plan is going to make the most sense. Because these loans have already been dispersed prior to January 1st, 2026, you're eligible for either income-based repayment or the repayment assistance plan. Now, the asterisk here is that if pay-as-you-earn makes sense during this period of time, that could be a viable option as well if your loans are eligible based on when they were dispersed. But again, as a reminder, pay-as-you-earn will be sunset over the course of the next 2 years. So then you would have to shift into income-based repayment, assuming it's still there and legislative changes haven't occurred.
Okay, Michael. So what I'm hearing from now what sounds like a lot of complexity is if I have had or possessed my loans for a longer period of time, I may still have the option to stay within the pay-as-you-earn or the pay plan. But by the time 2028 comes around, I'm going to need to be in IBR or the RAP plan.
Correct.
And if I'm a newer borrower, it either may make sense for me, I may not have the option whatsoever. I have to go right into IBR or RAP.
Yep. So just to provide more clarity there. So if your loans originated after July 1st, 2026, RAP is effectively your only income-driven repayment option. If you want to switch to anything else, your only options are going to be a standard repayment or refinancing to a private lender. Okay. Now, if your loans originated before July 1st, 2026, you may be eligible for income-based repayment or, of course, the RAP plan, repayment assistance plan. But switching back and forth could, and we already know this, trigger payment recalculations or may cause interest to capitalize, right? Now, those are different topics for a different episode. But in short, again, changes have come, they're being implemented, and if you're in an income-driven repayment trajectory for some form of forgiveness, it is definitely encouraged to take a look at your current strategy and what your new options look like so that you don't miss the boat moving forward.
Okay. So big picture, what I've heard in totality so far is if I'm a parent, I've got to keep my eyes open to determine whether or not a double consolidation makes sense for me, or I've got to determine if Parent Plus loans are even going to be a real avenue moving forward. If I'm a student or a borrower, I've got to be really conscious of what payment plan options I'm going to have for either my existing student loans or my more newly issued student loans.
Correct.
Now, with all of that in mind, I know there is still changes to be made or rules of engagement that can be adjusted, but how has the math changed from a more planning-based perspective, at least in what you're seeing for higher earners or borrowers coming into their first career with much larger student loan stacks?
Yeah, so the math has shifted, and one of the big variables that is causing the shift is the taxability of forgiveness, right? So I don't want to spook anybody by saying that, especially if you're on the public service loan forgiveness track, because that level of forgiveness is still tax exempt, tax free based on current legislation and IRS code, especially primarily at the federal level and in most states. You'll just want to check with the state that you reside in when the forgiveness occurs. So again, if you are on track for public service loan forgiveness and you are awarded forgiveness, that discharge should be 100% federally and in most cases state tax exempt, tax free. Now, heading into 2026, at the end of 2025, there was a provision that sunset that was set in place during the beginning of the pandemic. This made, back in March of 2020, all federal forgiveness tax exempt, both public service loan forgiveness and time-based forgiveness. Now that we're into 2026, any form of time-based forgiveness, anything that is not a public service loan forgiveness awardment, is going to be treated as ordinary income. Now, what does this mean? This puts extra emphasis on a future potential tax bomb depending on how big of a student loan balance that you may have. So let's take into account an extreme scenario that I went through in speaking with an orthodontist yesterday. This individual has over $900,000 in federal student loans. They're in year 3 or 4 of owning their practice, some young children, married, spouse is self-employed, and the reality is that they likely will not pay these loans off in full because of the amount of interest that is accruing. Based on the interest rate that they have, we calculated that on an annualized basis, it's like something like $58,000 in interest that is accruing, or at least that is due. Now, one of the strategies that we've looked at is, okay, well, time-based forgiveness makes a whole lot of sense because filing for bankruptcy is not an option for this business owner. And even then, it may not even be guaranteed that the courts actually rule in his favor to discharge the federal loans because there's only a handful of cases where this has actually taken place and where it's been successful over the course of the last decade. So in this scenario, it's understanding that, okay, well, if in the future, let's just say that there's $1 million forgiven, right? Even if he can just service his interest that's due over the course of the next, let's call it 17 years, because they've already been in repayment for some, and it's a 25-year time-based forgiveness. If we assume that the future tax bill is going to be somewhere in the realm of $360,000, well, it's like, okay, well, what does our savings power look like today, and how much do we need to be setting aside, and what does a realistic, expected growth rate look like for us to be able to hit this target in, 17 to 20 years? That make sense?
Yeah, it does. Is the federal loans that I have in my name, if I'm not in the public service sector, when they get forgiven, whatever's left on my balance is going to essentially be added to my tax return that year. And if I haven't planned accordingly from a tax liability and payment standpoint, I'm going to be in a world of hurt at that point. I don't know where I'm going to come up with $300,000 to pay a tax bill I wasn't expecting.
Right. And the way that we backed into, $360,000 to $400,000 is basically saying, okay, well, if you had $1 million forgiven, that alone is going to push you close to the 40, above 37%, which right now is like the highest marginal tax rate. So we just used a flat 40% federal tax rate, and that's where we're getting to that $360,000 to $400,000. Now, the neat thing, because time is on their side, if they can become proactive and prudent and good stewards of their cash flow, if they can save $2,000 per month as a business owner, in 17 years, they would only need to generate a negative 1.4% return on that money in order to have $360,000. Now, I say that from a humor standpoint because you can't earn negative 1.4% if you put it in the bank, right? You'd basically be spending your money. But that's basically showing you that, hey, you really don't need to compound anything if you can save $24,000 a year over the course of the next 17 years to prepare for this. Now, what if you saved that same $2,000 per month and you generated a moderately conservative 6% net return over the course of 17 years? Well, that balance looks something like $717,000, right?
So well covers the tax bill at that
Well
point.
covers the potential tax bill. Now, if this individual can't service the interest alone, well, then that tax bill is going to be higher, right? Because if it's at $900,000 today, $58,000 of interest that's accruing each year, it could be a $1.3, $1.5 million forgivable balance, right? We just don't know. And in this scenario, it's more of a, hey, let's slow play it, let's survive and advance it. Ideally, for an orthodontist, this practice should start to generate significant leaps and bounds of income and revenue, by year 6, 7, 8, 9, 10 as the practice continues to fill up. But in the meantime, we have to survive and advance through these years. So could he make a dent in his loan balance by the time it's forgiven? Absolutely. But this is where we have to figure out the opportunity cost with every decision that's being made. So all that to say, forgiveness is still a viable option for borrowers. It's becoming a limited option for parent plus borrowers, parents who are taking out loans on behalf of their children. There is a tax bomb that is coming due again. So anyone who is not receiving public service loan forgiveness, and because there have been changes to your income-driven repayment options, the amount of interest that accrues long-term is going to significantly impact the time-based forgiveness borrowers more so than the public service loan forgiveness. Because with the Saving on a Valuable Education Plan, unpaid interest that accrued was being forgiven through interest subsidies. And in my opinion, this is just my personal professional opinion, that's what triggered the lawsuit, is it was a little too generous. But traditionally with pay-as-you-earn and income-based repayment and income contingent repayment, any unpaid interest was just accruing in a separate bucket known as an unpaid interest bucket, right? So it doesn't necessarily compound in the same aspect of as other debts because the annual interest due was purely based off of the current outstanding principal balance.
What I'm starting to hear then from this conversation is if I'm a borrower, this idea of forgiveness is basically not a free pass or the check mark to wealth creation once my 20 years or 25 years is up. It's now becoming much more of a strategic math problem or planning problem that needs to be addressed year by year to see where things stand, but with enough forethought, knowing that this tax bill is coming and there's some real wealth creation that it can occur, but it's going to take some discipline ultimately to get there, a plan in place.
Correct. If I had to add to that, it would say, okay, well, the RAP payment structure may alter negative amortization for these borrowers and for just the behavior in general, but also forgiveness modeling is going to become more complex for borrowers. So this is where it's very important to work with, in my opinion, a trusted embedded financial advisor that specializes in student loan planning. Again, student loan planning meaning paying back loans that have already been taken out, or a certified student loan professional. And then just making sure that you can be prepared for long-term tax implications, because this is very much relevant. It's back into the spotlight and it's something that you have to be made aware of. One of the things that we've talked about in past episodes is what the hurdle rate is for the opportunity. If the interest that's accruing on your federal student loans is, let's call it 5.5% or 6%, but your investments are growing at 8, 9, or 10% on average, well, where does it make sense for you to throw extra money? And without the modeling and the forecasting and the understanding of how all this works, it's really hard to make that decision. And you could be making a choice that would negatively impact your future wealth building potential as well as your future retirement.
To summarize, at least what I'm hearing so far is parents need to be generally concerned over new loans, existing loans. Borrowers need to be concerned or at least aware that there are changes coming in their repayment plans. And from a mathematical perspective, there's very much projection-based planning that needs to occur to prepare not only for tax bills, but also for retirement and longer-term wealth creation. Now, I know that SAVE, the Save on a Valuable Education Plan, had interest subsidies. Do you see anything or real relief from RAP Plan or IBR out there today, or is it a completely new environment?
So it's somewhat of a completely new environment, although the RAP plan is supposed to have some layers of interest mitigation, but it's not structured as a pure monthly interest wipe that the SAVE plan offered. Again, with the SAVE plan interest subsidies, balances generally did not grow if payments were made, as long as you were making your minimum payment, even if it didn't cover the monthly interest that was due. Now, with the RAP plan, instead, the design is supposed to have caps on excessive growth. And the intent of these caps is to reduce long-term compounding risk to the actual borrower. So it could be based off of a number of years in repayment to where you're only paying a set amount. I think I've heard or read somewhere that they're looking at, as long as you pay back your principal amount borrowed over the course of your lifetime, any accrued interest beyond that doesn't have to be repaid. I think they're still working through some of those fine details. But at its core, the exact subsidy mechanics are really going to depend on the income tier of the borrower, as well as the payment calculations that are being provided within that RAP plan. So all in all, it does offer some protections, but not identical to the SAVE plan's interest shield that was being offered to borrowers.
So a simplified summation of this entire conversation, which is an answer as financial representatives and planners that we are, is it's an always it depends answer.
Right.
Whether it's what plan should we be in, how should we be seeking forgiveness, how should we be tackling and creating wealth long-term alongside of these student loans. So with all of that in mind, if you have 6 figures in federal student loans, now starting in 2026, it's not a wait and see type of year or planning approach anymore.
Exactly. It's, hey, we have to take action now, especially if you're a parent with plus loans, midstream in public service loan forgiveness, and worried about whether or not you're on target for your end date, or pursuing time-based forgiveness. The environment is shifting from flexibility to structure, and you do not want to miss out on opportunities.
And at this stage, deadlines really begin to matter, documentation matters, and longer-term strategy matters.
If you want clarity on whether to consolidate, shift plans to a different income-driven repayment plan, accelerate your payoff to negatively amortize the loans faster, or stay the course, that's what we do here at Genesis Wealth Planning. So definitely feel free to reach out to us directly. Head over and check out the show notes. Feel free to schedule a complimentary consultation just to review what you have going on under the hood. And of course, always feel free to submit questions through our Ask Me Anything page. That's at www.genesiswealthplanning.com/AMA. Don't forget to like, subscribe, and share with anyone that you think that this could add a positive impact to.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
7237198.28, expiration 228.